All right, we have more changes unfolding in the U.S. economy and in the U.S. housing market. Changes that have home sellers suddenly dropping their asking prices in many parts of the country. And it's not just home price cuts either. We're talking about inventory seeing substantial moves up, actually hitting a new 2023 peak. Price cuts, homeowners relocating suddenly, and more as these higher rates are starting to work their magic. We're going to look at exactly what just happened, why the brokerages are suddenly warning of a cold winter, they say, for residential real estate. And I've been watching this happen these past few weeks, but I wanted to wait for all the data to arrive. Well, it now has. At 12:01 a.m. yesterday morning, the last of the big three real estate brokerages released their September data to us, that being Zillow, who's always last to publish. So we'll use Snapforce Real Estate Insights to dive in and look at the markets with the largest price cuts, but we'll also look at the sudden upswing to inventory, and we'll look at a surprise nugget of information released this week in the slew of new econ data that we just saw, a nugget that could help explain why this may be happening right now, as this movement is much more than just seasonal. But before we get started, press the like button and subscribe. It's all I ask for in return for making these videos. It helps me out, and I appreciate your support. Also, if you want access to the maps and charts and all the data that I use in these videos, I put the link in the description below. So interest rates, folks. Rates across the board have been ticking higher, something that we need to keep an eye on, obviously, but also keep in mind that bond markets are still markets, and these big portfolios who trade in fixed assets really do move prices. There are so many machines that trade automatically nowadays for these big money funds that seeing rates tick down one day isn't indicative of anything. Their algos are programmed to buy and sell automatically, especially after the last few weeks of non-stop selling, and bonds were oversold, completely washed out. But in the big scheme of things, nothing has changed yet. Nothing has changed yet. Treasuries are still extremely cheap, mortgage-backed securities even cheaper, and we still have significantly too much government debt and too few buyers for that debt. The dynamics are exactly the same as they were last week. And we're on a crash course, by the way, as the days are running out before the debt ceilings hit again, which means should a deal be reached in November, trillions more in U.S. government debt will be spun up, and the Treasury will start their auctions, and yields will likely continue rising. If a deal isn't reached, though, or the Fed makes a sudden policy shift or change in next month's FOMC meeting, then really, like, anything could really happen. But at the moment, we have rates across the board now at their highest levels in over 15 years. Auto loan interest rates, for example, close to now touching 8%. That means that the interest rate that you and I pay to buy a car has doubled in under a year. And we all know what mortgage rates look like right now. As of this morning, 7.67%. All of this, along with lenders tightening their lending standards, making it harder to qualify for just about any kind of loan imaginable, is finally beginning to bleed through into the data. Take auto loan delinquencies, serious delinquencies, which you could see right here. And according to Goldman Sachs, who just wrote a note specifically about this and why it's a problem, take a look at this. The title of the piece was Credit Cards, Debt versus Delinquency. Sent out by them yesterday, they wrote this. In recent months, we have received several client questions about credit card debt and concerns about the fact that it exceeded $1 trillion for the first time ever in Q2. But in our view, the development is neither surprising or particularly worrying. But credit card delinquencies, on the other hand, are a different story. New 30-day and 90-day delinquencies have been rising sharply, and the former was even above pre-COVID levels in Q2. They wrote this. This suggests that total delinquencies could trend up in coming quarters. Q3 data will be released early in November. Bottom line, they write, when it comes to credit cards, investors should focus on delinquencies, not debt, and the rise in new delinquencies is a point of concern. So it's taken a while, but the lag time in which it takes before the Fed's tighter monetary policy has a chance to actually work its way through the system is finally running out, as the effects reach some people quicker than others, depending on their current financial situation, of course, if they have any floating rate debt, for instance, an adjustable mortgage, or if they just lost their job, maybe. Think about it like piping throughout the entire country, running to each and every one of us. Every person, every business, the Fed turns the dial, right? Tightens monetary policy, and the lag time between them doing that and the effects working their way through to all the financial pipes, reaching some of us quicker than others, but eventually hitting enough of us, reaching critical mass, or what's been dubbed the hard landing scenario or recession. Now, it normally reaches and unwinds interest rate sensitive sectors of the economy first, which it did. That's already happened and happening. The rise in delinquencies that we just spoke about, commercial real estate defaults out the wazoo, not to mention that the housing market is in the toilet, folks. The slowest housing market ever right now, like you see on this chart, significantly worse even than what we saw during the worst days of the last housing crash, right? But we still have home prices close to all-time highs. The housing bubble yet to deflate, and we all know why. A shortage of available inventory. Not enough homes are currently being sold to really drive down prices. Well, take a look at this. The newest housing numbers for September. Inventory over the last 2 months has jumped quite significantly. Total active listings just crossed 700,000. First time that's happened in 11 months. Realize we need to get back between 1 to 1.2 million active listings. That's where we used to float around pre-pandemic. And it's clear as a bell that lack of inventory is the only thing holding a housing crash at bay, or at least a significant correction. And you could see what happened last year. As inventory began to increase, prices began to fall. Well, the last 2 months, we've seen a run-up in new listings, much too high to be chalked up to just seasonality. Even Zillow published an article talking about this, how the listings drought has modestly improved and how asking prices are being cut left and right. Writing this, fall housing market outlook cooling quickly. The seasonal cool down for the housing market shaping up to be extra chilly this fall, swinging negotiating power toward buyers, which we can see for ourselves back in Snapforce. Largest increase in month-over-month price drop since July of last year. That was the month after the national peak was hit, right? And to get an idea of what this looks like, here's September's numbers. Look at the difference between the number of sellers who reduced their asking price versus increased it. For example, Phoenix, Arizona saw the largest number of price drops last month. Out of 7,000 listings, 4,400 cut the price. Only 300 increased the price. Here's an interesting one. Harris County, Texas. That's the Houston area. 4,100 listings saw a price cut. Only 200 increased the price. And it goes on like this. Look at the difference all the way down the report. The vast majority of sellers are cutting prices right now, not raising them. But it takes time, right? The housing market is ultra slow moving, but we are seeing it begin to reflect in the data. We could see it on our home value map. The data on this map is from Zillow's Home Value Index. The redder a county is, the more prices have fallen. The bluer a county is, the more prices have risen. The dark red means prices are down double digits from last year. And this is as up to date as you're going to get. Zillow just synced their newest data set to us yesterday morning at 12:01 a.m. Now, one state that's seeing a ton of price drops is Mississippi. I don't think we've ever actually covered Mississippi, mostly because there's not that many of you who really ask about it. But let's take a quick look. Jackson, Mississippi, now down over 8% since last year, falling continuously all throughout 2023, even during the spring selling season. Typical house here now valued at $113,000. That's still 20% over September 2019 prices and 40% over September 2017 prices. And wow, back in September 09, typical home was only $67,000 here. Also, if I miss your area as we go through this and you want me to cover it, just leave me a comment and I'll try to get to it in the next housing video. Or if you don't want to wait, I put the link to Snapforce Real Estate Insights in the description box of this video. And since we're down south already, let's just jump next door and look at Louisiana real quick. How about New Orleans, Jefferson Parish, now down 12% since last year. Typical house here cost $228,000. Consistent month-over-month price drops and almost back to pre-pandemic prices now. Only 4% over September 2019, 17% though over September 2017 prices. All right, let's check out Florida real fast. Well, how about Jacksonville? Jacksonville, Florida, we are now year-over-year negative, but prices here are staying flat for the most part. Typical house now valued at $305,000. That's still 55% over September 2019 prices and 77% over September 2017 prices. But again, If you want to see why, take a look. Inventory in Jacksonville is still over 1,500 listings short from where it needs to be. The blue line's active listings, orange line, home price. To see relief in prices, we need to see this gap start closing. It's the one consistent thing that you'll see when you look at the data in here is the markets that are red on this map all have one thing in common. Inventory has been normalizing in these markets. All right, why don't we fly across the country over to the beautiful Pacific Northwest? Let's check out Seattle, Washington. Now down 9%, current home selling for $807 grand. Still 35% over September 2019, 45% over September 2017 prices. How about compared to the previous housing bubble, though? Whoa, 85% over September '06, over the peak of the last housing bubble. Pretty wild. And I know I'll hear it in the comments if we miss Boise, Idaho, now down almost 12%. Typical home valued at $490 grand, still 50% over September 2019, 92% over September 2017 prices, and 140% over September 2006. All right, that wraps up today's video, but I want to mention I've been getting your emails and messages on X requesting more housing content. The thing is, I like to make housing videos when there's new information, new data to share with you. But if you are looking for daily real estate content, check out Travis over at Real Estate Mindset. He's got a good channel. He's a good guy, good person, and talks real estate every single day. All right, I hope you enjoyed this video. If you got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.